Transferring business ownership in California involves complex legal and tax considerations that can significantly impact both sellers and buyers. Understanding these requirements is essential to avoid costly mistakes and ensure a smooth transition. Business ownership transfers in California require careful assessment of legal, tax, and financial implications. The state defines a change in ownership as occurring when a portion or entirety of an entity's ownership is transferred from one individual to another, when an entity dissolves and forms a new one, when businesses merge, when assets are conveyed to another entity, or when a receivership takes control. California recognizes several types of business ownership transfers, each with unique requirements. For sole proprietorships, since the business and owner are legally the same entity, only assets can be transferred rather than the business itself. Partnership transfers require agreement between partners, with ownership percentages reassigned according to the partnership agreement. Limited liability company transfers depend on the operating agreement, with membership interest transfers requiring proper documentation and potentially state filings. Corporation ownership changes involve stock transfers, though shareholder agreements may impose restrictions. Mergers and acquisitions require compliance with both state and federal regulations. When transferring a sole proprietorship, remember that you can only sell its assets because the business and owner are not separate legal entities. This process involves listing all assets being sold, drafting a contract, and specifying what the original owner retains. Proper legal documentation is crucial for any business transfer. This includes a letter of intent outlining terms before formal agreements, a comprehensive business sale agreement detailing purchase terms and liabilities, a bill of sale confirming asset transfer, and potentially a non-compete agreement. Other important documents include assignment of lease agreements, employment contracts for continuing staff, and necessary regulatory filings. For sole proprietorships operating under a doing business's name, transferring the DBA requires contacting local authorities. Existing contracts may be assigned to the new owner, but some clauses might restrict transfers, so informing the buyer beforehand is essential. Business goodwill represents intangible value, including reputation, customer relationships, and community standing. Properly valuing this goodwill often requires professional expertise. The transfer agreement should detail all assets, sale terms, and include clauses like non-compete provisions. Before transferring ownership, valuing the business accurately is critical. Common methods include asset-based valuation, considering tangible and intangible assets, market-based comparisons with recent similar sales, income-based projections of revenue and profit, and discounted cash flow analysis of future earnings. An independent valuation provides a solid foundation for negotiations. Tax considerations are significant in business transfers. The Internal Revenue Service treats different asset sales separately, affecting tax obligations based on purchase and sale prices. Various assets fall under different tax rules, making professional tax guidance valuable. When transferring to a successor, consider implementing a training period, properly notifying employees, and maintaining customer relationships to ensure a smooth transition. This helps preserve the business's value during the ownership change. Understanding these legal and tax implications is essential for California business owners contemplating ownership transfers. Consulting with qualified legal and financial professionals can help navigate this complex process and avoid potential pitfalls.